Hello and welcome in everybody to another episode of the Magnify Wealth Podcast. I'm Cameron Gannon, here at my co-host, Scott Gannon.
Good day, everybody.
Please give that video a pause, go down, like and subscribe, and come right back. Today we're talking about the TFSA versus whole life insurance in the Canadian landscape. So just to kind of give you a brief overview, TFSA stands for Tax-Free Savings Account. It's a government account that allows you to put so much money in that will grow in whatever investment you want to put it in, tax-free. So whole life insurance is, of course, life insurance that has a cash value. That cash value will grow guaranteed, again, tax-free. So, we're going to help you today with figuring out what vehicle or vehicles to use when to enhance your cash flow to help you create that multiplying effect on your money. So why don't you help us out with the basics of the TFSA?
Sure. So TFSA, basically, if you've ever saved money in an RSP, it's almost the opposite of that, in that you use after-tax money, not pre-tax money. So what happens is once you pay the tax, you're kind of done with it. So you put the money in, and whatever growth happens or lack thereof, you don't pay tax on it. Now, of course, the other side of that coin is you also can't losses. You can't deduct losses. So although you are tax-free completely, I guess it's tax-free even when the tax could be beneficial to you. But there are contribution limits as well, and those start in 2009, and I think it's around $7,000 in that range right now, but you can go back and use unused amounts from the time you were 18 and had a SIN number up until whatever age you are now. You can accumulate those from 2009. Quite flexible, and they are accessible. So what that means is you can have, if you had $10,000 in there and it grew to $15,000, and you decide to use it for something else, so you withdrew the $15,000, your contribution room would gain that back. So you gain the full $15,000 back, not just the 10, which is kind of cool. But on the other side of that coin, again, on the loss side, if you put the 10,000 in, it drops to 5, you take it out, you're only gaining back the 5,000 in contribution room. And that is on an annual basis, so it's always a filing part with your provider, with the government. So that's the one key thing is this is a government created program, so CRA and the government are always aware of where you are with your contribution limits, as well as the amount of money that's in there. That's reported annually. So that's basically it. It's it can, and there's limitations on the investments, just like an RSP.
So whole life insurance is like what you've heard of before in term life insurance, except with whole life, instead of we will pay you if you die in this period of time, whole life insurance is simply we will pay you when you die at some point in the future. So because the insurance company knows that at some point you will die, they will basically offer a certain amount of money called the cash value that you can take to go away and then not have to pay that death benefit. So that cash value, because you're getting closer to death every single day, that cash value is guaranteed to increase every single day, and that happens tax-free. So that cash value can be withdrawn in the same way life insurance can, but the same way TFSAs can. But the way we use it is you take policy loans against that cash value to give a multiplying effect with your money. So just to compare what TFSAs to from the contribution side, because it's life insurance, you're charged a premium. That premium does not go up. It's with whole life insurance, you have a guarantee that it's going to stay steady for as long as you're paying, whether that's 10 years, 20 years, your whole life, whatever it is, it's guaranteed to not go up. But the contribution limits that the TFSA have are not in place for life insurance. With life insurance, you can get up to what the company decides is your human life value, and you can put a lot of premiums in to get to that point. So So there's not the same worry with a TFSA that you're going to go over.
Yeah, so there's no over contribution. Yeah, you're on, just to tie that up, it's always based on your human life value, how much death benefit you have, and the death benefit dictates how much premium you can put in. But because again, the way we structure things, we want to overfund these things as much as we can up to the limit of that the government allows from a tax-free growth standpoint. So we'll kind of go into the key differences here. So which were kind of I guess a little bit in defining them separately, but let's just take these down. So first thing, from a liquidity standpoint, the TFSA is liquid. That said, depending on what you're investing in, that liquidity you may not want to have. So if you are investing in a stock market vehicle or a mutual fund or whatever, and that happens to be down in value, then the idea of using that money versus redeeming it, that's the difference, right? So you'd have to redeem it to use it. TFSAs can't be used as collateral for any kind of loan or anything. No registered product can. So that is the biggest liquidity difference here. So when you're accessing cash value from a life insurance policy, you can, as Cameron mentioned, you can redeem it or withdrawal like a TFSA, but we never recommend that, although it's definitely available to you. We recommend that they use the policy loan provision, which is an on-demand order, not an application. So when people think of loans, they think of lengthy credit underwriting processes. That doesn't happen here. As we've discussed many times, the loan is on demand. You are in control. Because life insurance companies have a unique ability there in that they are the lender and the guarantor. So there's no application needed.
So what about what you guys are all probably thinking? Growth potential. So TFSAs, well, that depends. What you got to understand is a TFSA is simply a type of account that an investment goes into. It's not actually an investment. So the growth potential depends on what the investment is. That can be, whatever type of investment you want to put in there. Well, look at what the growth potential is of that, and remember that is going to be tax-free. And if it goes down, that you're not going to be able to claim the losses on that. With whole life insurance, the growth inside the policy, the cash value, is what we call the internal return. That is guaranteed to grow, and you can expect an internal rate of return over the course of your life between 4 and 5%. Again, that's tax-free as well. But also with life insurance, because you can take a policy loan, you could invest that in whatever you want, and that creates an external return as well. And at the end of your life, there's a death benefit that pays out, and that creates also an eternal return for your next generation. And the final thing we'll look at is tax treatment between the two and how how you're accessing your money. You already kind of explained with TFSAs, when you withdraw money under the TFSA, whatever you withdraw that next year will be available to put back in, whether that is you're withdrawing a gain, you're withdrawing a loss, whatever the amount is will now be available to you in the next year. With life insurance,
they're never taxed, right? The withdrawals.
Yes, exactly. Taxed, right? And with life insurance, when you're taking loans, when structured properly, they again also like the TFSA will never be taxed.
Yeah, you got to be careful with the loans as time goes by. Certainly not early on, but and that's where we come in as wealth coaches, and it's important to have a good coach for this. Is knowing how to navigate the tax-free nature of utilizing this money to your advantage. So that's the big thing to keep in mind.
And now, why don't you take the listeners into a hypothetical here on when to use the TFSA versus and use the whole life insurance.
Yeah, so I've always looked at, and this goes back to when TFSAs first came out. Once I understood how they worked and the value in them, this was before I discovered the real value in whole life insurance. Oddly enough, considering I started the life insurance business, but that's another story. So is what I've established with the tax-free savings account versus, like, let's just say an RSP. You want the RSP, you want the TFSA to have the most growth. Why? Because that's the one that you're gonna be worried about, I guess, when you are retired, is how much taxable income do you have. So the way I've always looked at it is your TFSA, if you were gonna take a small portion of your capital, let's just say whatever it is, 5 or 10%, and kind of take a huge risk with it. So like a hypothetical, if you're looking at an investment with an expected return of, I don't know, 40, 50, 100% or whatever, or a high risk loan or something like that, then this could be something that you would use it for. Why? Because again, the gain is tax free. So that would be my idea of the ideal use of a TFSA, is something high risk where you're either going to lose, you're going to lose your money, or you're going to just make bank. It's going to be, kind of explosive results, if you will. And I liken that to, I'm not liking it. It's what I'm getting at here is when you're using cash value life insurance, there is a leverage component of that. So I always want to look at and recommend to people when they're taking advantage of opportunities to find cash flowing or cash producing assets, whether that's another business or a piece of real estate or some sort of a private loan or something that's going to give you consistent cash back to constantly reduce your risk attached to leverage. But again, understand too that this is already conservative leverage because your collateral is always growing regardless of what the outside investment is doing. So I think that's the I guess the gist of where would I use a TFSA versus this would be something that you might want to consider. The TFSA is if you won the lottery, if it pans out. And with cash value life insurance, I always like to see cash flowing assets. Period. That's kind of how I look at it.
So to wrap things up, I guess the major thing to realize is they are both very similar from the jump, in that you use after-tax money to put it into a vehicle that's going to help you not pay tax again on that money, while obviously there are some significant differences once that cash is in there. So for our listeners, please do reach out. We can both help significantly in helping you use cash value life insurance to position yourself to be able to use both accounts in a successful manner.
Yeah, I mean, the bottom line here is you have a TFSA already, or you want to start contributing to one, great. We can help you get connected with the right people for that, as well as how that can be an actual supplement to building out a infinite banking style of life insurance policy. But keep in mind too, the biggest difference here is life insurance has a death benefit. TFSA has money. That's it, and whatever that money's worth, that's what you have. So.
Thanks.
Anyway, again, we invite you out to talk it through, and if you really want to, get real clarity on the differences.
Thanks for tuning in, everybody, to the Magnify Wealth podcast. We'll see you guys next week. Signing out, Cameron Gannon and
Scott.
Thanks for tuning in to the Magnify Wealth podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.